You know what billionaires are buying these days? Gold, Bitcoin, real estate, stocks. The usual assets that dominate the headlines and keep financial media busy. Whenever gold climbs to explosive levels like $4,000 per ounce, every network rushes to report that hedge funds and sovereign wealth funds are accumulating. When Bitcoin surges towards six figures, the narrative becomes that the ultra-wealthy are diversifying into crypto, hedging against inflation, and positioning themselves for the future of digital finance. When real estate markets heat up, we are told billionaires are purchasing buildings, farmland, islands, and entire neighborhoods. All of this becomes part of a predictable cycle. The public watches, analysts explain, and retail investors try to mimic moves that were made by the rich years earlier. But this is the surface story. The part designed to be visible. Behind the noise, something else is happening. While the world obsesses over gold and Bitcoin, and while everyday investors chase the same assets repeatedly glorified by financial commentators, the ultra-wealthy quietly move into an entirely different category of assets. Not the ones you hear about on CNBC or see trending on social media. These are assets so specialized and so deeply tied to real-world survival that most financial advisors can't explain them, and most investors do not even know they can be purchased. They are accumulating three categories of assets that appear unremarkable at first glance, but in moments of global stress, they outperform every shiny object you have been told to watch. And billionaires are doing it quietly through shell companies, trusts, private deals, and legal structures engineered to obscure ownership. No interviews, no press releases, no public bragging, just methodical, steady accumulation, because they understand where value concentrates when systems fail. The first asset might surprise you because it sounds boring. Farmland, but boredom is a disguise. When currencies wobble, when trade routes break, when geopolitics reshape supply chains, nothing is more valuable than control over the means of food production. Not food itself, anyone can buy grain, but the capacity to produce food indefinitely. Farmland is not just dirt. It is a store of energy, water, nutrients, and future production capability. And no one embodies this strategy more than Bill Gates, who, through Cascade Investment, has quietly become the largest private farmland owner in the United States. As of 2020, Gates holds roughly 2.1%, an astonishing expanse equivalent to about 430 square miles, larger than entire major cities and comparable to the size of Hong Kong. He has been accumulating these holdings for more than a decade, not randomly but with surgical precision. What makes this especially revealing is not the total acreage, but the pattern. His largest concentration lies in Louisiana, nearly 70,000 acres across the Mississippi River Delta. That region possesses three characteristics that cannot be easily replicated. Ultra-rich alluvial soil deposited over thousands of years, a virtually unlimited water supply from the Mississippi River and underlying aquifers, and one of the longest growing seasons in the country, allowing multiple harvests per year. This is not land purchased for hobby farming. It is strategic control over one of North America's most productive agricultural zones, at a time when soil degradation and water scarcity are accelerating globally. Gates's second largest holdings are in Arkansas, tens of thousands of acres in the heart of rice and soybean country, with direct access to the Arkansas River. These are crops that require tremendous volumes of water, and in a time when water stress is becoming one of the defining challenges of the century, This region remains one of the few with a reliable and legally defensible water supply. The third major cluster is in Nebraska, where the land sits above the Ogallala Aquifer, the largest underground freshwater reserve in North America. Much of the aquifer is being depleted, but Gates's purchases are in the deepest, most stable sections, where recharge rates ensure access for decades, even centuries. He also holds expansive farmland in Washington state, much of it in the Columbia River Basin, where wheat, potatoes, and fruit thrive, thanks to stable climate patterns and extensive irrigation infrastructure. Florida represents another strategic acquisition, nearly 15,000 acres capable of producing citrus and vegetables year-round. Every purchase follows the same logic: premium soil, reliable water, and resilient climate conditions. Gates is not buying for today's yields. He is buying for the day when food production becomes the most decisive economic and geopolitical advantage. The world is entering an era of climate stress, volatile weather, and disrupted supply chains. Whoever controls productive farmland will wield extraordinary influence. This strategy continues today. In mid-2020, his investment firm acquired another sizable parcel in Washington's Horse Heaven Hills region. Highly engineered crop circles, pivot irrigation systems, deep aquifer access, mineral rights and water rights included. He paid around 4 times the national farmland average per acre. Not because of speculation, but because this land represents guaranteed long-term productivity in a world where such land is getting rarer every year. This brings us to the second asset. Billionaires are quietly accumulating water rights. Not water itself, not barrels or tanks, but the legal right to extract and use water from rivers, aquifers, and watersheds. In the western United States, water rights often function as a separate property class. You can own land, but have zero legal claim to the water beneath it or around it. Under the doctrine of prior appropriation, first in time, first in right, those who obtained water rights in the 1800s often hold senior priority. During droughts or shortages, they get access first. Junior rights holders can be cut off entirely. And since water is increasingly scarce, these rights have become one of the most valuable assets in America. More valuable, in many regions, than the land itself. Water rights can be bought, sold, leased, and transferred independently, and they are often more valuable than oil reserves or rare minerals, because every city, developer, and agricultural producer depends on them. When growth collides with limited supply, water becomes the ultimate choke point. Billionaires understood this decades ago and began systematically acquiring senior water rights before the public even realized these assets existed. One of the earliest and most aggressive was Boone Pickens, the Texas oil magnate. Starting in the 1990s, Pickens purchased massive tracts of land in the Texas Panhandle, not for crops or grazing, but for the water beneath them, drawn from the Ogallala Aquifer. Over time, he assembled rights to extract around 65 billion gallons of water annually, positioning himself to supply municipalities that would inevitably face water shortages. Pickens was not alone. Hedge funds, private equity firms, family offices, and sovereign investment groups have followed the same strategy for years. They understand that water scarcity will define the next century far more powerfully than currency fluctuations or stock market cycles. When regions run dry, water rights become the ultimate collateral, the ultimate leverage, and ultimately, the most non-replicable asset on the planet. Most people spend their financial lives chasing visible trends. The ultra-rich chase the fundamentals of civilization: soil, water, and control over the systems that sustain human life. That amount of water, 65 billion gallons per year, is enough to supply a city of 1 million people. And Pickens did not need to build a dam or drill new reservoirs. He simply owned the rights to extract it. In 2011, he sold a portion of those rights to 11 Texas cities, including Amarillo and Lubbock, for $103 million. He did not sell the land, nor the physical water. He sold only the legal permission to pump it. The price worked out to roughly $1 per 1,000 gallons, a staggering multiple compared to what municipalities typically pay for water sourced through regional utilities or river systems. Those sources cost pennies per 1,000 gallons. Pickens earned a tenfold return simply by controlling access. And critically, he still holds the majority of his water rights. Today, those remaining rights are valued at more than $500 million, and that valuation rises every time drought forecasts worsen or aquifer depletion accelerates. But Pickens was never the lone visionary. His strategy sparked an entire ecosystem of financial entities who realized that water scarcity would become one of the most profitable and morally complicated investment opportunities of the 21st century. Firms like Water Asset Management, based in New York, quietly began buying farmland in Colorado, not because they wanted to grow alfalfa or manage ranches, but for the water rights attached to the soil. They acquired more than 20 acres along the Colorado River. The land itself might fetch around $50 million on the open market, but the water rights, especially senior rights dating back generations, are valued at more than $300 million. Their business model is explicit: profit from scarcity. The firm purchases land with senior rights, upgrades irrigation systems to reduce water usage, then sells or leases the saved water to growing cities or thirsty developers. It is water arbitrage, extracting financial value from the structural imbalance between supply and demand. And within current legal frameworks, it is completely permissible. California provides an even more astonishing example. Stuart and Linda Resnick, owners of the wonderful company, the brand behind pistachios, pomegranate juice, and citrus products, built their modern empire not on agriculture itself, but on controlling the water that makes agriculture possible. Their ascent began in the 1990s, when they bought tens of thousands of acres in the Central Valley. With that land came precious water rights in one of the most stressed watersheds in the country. But they went further. In 1999, while many cities were barely aware of water regulation debates, the Resnicks attended state meetings that would reshape water distribution for decades. Those meetings enabled private entities to control water banking systems, massive state-funded facilities that store water during rainy periods and release it during drought. Through a series of acquisitions, the Resnicks took control of the Kern Water Bank, the largest water storage facility in California, capable of holding 1 million acre-feet, which is roughly 4 billion gallons of water. During drought, when rivers shrink and restrictions tighten, the Resnicks sell water from the bank at enormous markups. Billion-dollar profits have flowed not from farming, but from controlling a public resource stored in infrastructure originally paid for by taxpayers. Their story demonstrates something critical. Water is no longer just a natural resource. It is a financial instrument. Other players have entered this arena as well. In 2021, the Church of Jesus Christ of Latter-day Saints spent over $200 million purchasing 20,000 to 25,000 acres of farmland in Washington state. They even outbid one of Bill Gates's investment entities. The land itself is fertile, but that was not the primary prize. Attached to it were senior water rights along the Columbia River state rights that guarantee perpetual access, regardless of future scarcity. That purchase elevated the church into the ranks of the largest agricultural landowners in the West, not because they needed the crops, but because they recognized the enduring value of water. And the consolidation continues. Also in 2021, a company called Crown Columbia Water Resources, backed by major Wall Street investors, submitted an unprecedented auto application to Washington state, seeking authorization to acquire private water rights across the Columbia River. Watershed. The plan was simple. Buy water rights from farmers, store them in state-managed banks, then lease or sell that water to cities and industrial users for enormous profit. Had it been approved, it would have been the largest private water rights acquisition in Yippur. History. Public backlash halted the proposal, but it did not stop the firm. Instead, they shifted tactics, quietly completing smaller deals that bypass regulatory scrutiny. This is the pattern: persistent, strategic consolidation of the most essential resource on Earth. The message is unavoidable. Water rights across the American West are being absorbed by billionaires, investment firms, and institutional players who understand that scarcity is inevitable. Climate models are unified. Snowpack in the Rockies is shrinking. The Colorado River has lost around 20% of its flow over the past century, and aquifers like the Ogallala are being pumped far faster than they can recharge. Demand continues to rise as populations expand. The economic outcome is predictable. The owners of water rights in the coming decade will wield influence comparable to the owners of oil in the 20th century. The difference is existential. You can live without gasoline, but you cannot live without water. And now we arrive at the third asset the ultra-wealthy are accumulating, an asset so obscure that most people have never heard of it, and most financial professionals cannot explain it. Yet in 2025, it has become one of the fastest-growing investment markets among billionaires. These assets are called catastrophe bonds, bonds for short. They occupy a corner of finance that blends insurance, global risk, and speculative yield in ways that seem almost paradoxical. Catastrophe bonds were created to transfer disaster risk away from insurance companies and into the hands of investors willing to take the bet. Suppose a major insurer covers thousands of properties in Florida for hurricane damage. A direct hit by a Category 4 or 5 storm could trigger billions in claims, potentially more than the insurer can absorb. Traditionally, companies buy reinsurance to spread this risk, but reinsurance capacity is limited and increasingly expensive. To solve this, here's how a cat bond works. The insurer forms a special purpose vehicle, essentially a dedicated shell company. That company issues, for example, $500 million in bonds. Investors buy the bonds. Their $500 million is placed into a secure collateral account, often holding it to as Treasury securities. In exchange, investors receive high yields, typically 5% to 10% above Treasury rates. So if Treasuries yield 4%, cat bonds yield 9 to 10%, sometimes more. As long as no catastrophic event occurs, no mega hurricane, no massive earthquake, no billion-dollar wildfire, investors collect their hefty interest payments and eventually receive their principal back. But if a qualifying disaster does occur and damages exceed a predetermined threshold at, say, $10 billion, the bond triggers. The collateral is transferred to the insurance company to pay claims. Investors lose some or all of their principal. In essence, investors are betting against disasters. At first glance, this seems reckless. Who would willingly risk total loss? The answer: billionaires, hedge funds, pension funds, sovereign wealth funds. Any entity seeking high yield that is uncorrelated with stock markets. And the returns justify the appetite. In 2024, catastrophe bonds returned an average of 17.4%, dwarfing the S&P 500's roughly subtle return, and far surpassing the FARC yields of corporate bonds. In 2023, cat bonds returned 19.8%, again outperforming nearly every asset class on Earth. Even during the market turmoil of 2025, when tariffs and geopolitical tensions caused the S&P 500 to plunge 15%, catastrophe bonds gained. They rose while stocks fell, real estate sagged, and even gold wavered. The ultra-wealthy do not chase what the public watches. They accumulate the assets that matter when systems break: land that feeds people, water that sustains life, and instruments that profit from chaos itself. Why? Because tariffs do not cause hurricanes. Trade wars do not generate earthquakes. Stock market crashes do not trigger floods. Catastrophe bonds operate in a completely different universe from traditional financial assets. Their performance is tied solely to physical natural events. Storms, quakes, fires, forces that ignore interest rates, recessions, elections, and financial panic. This is the fundamental insight billionaires understand that retail investors often miss. True diversification does not mean owning both stocks and bonds, because those two still dance to the rhythm of the same economic cycle. When the economy falls apart, both tend to fall together. Real diversification is owning assets whose value is detached from macroeconomic swings. And among all alternative assets, catastrophe bonds. The cat bond market represents the purest form of that separation. The market has expanded explosively. As of late 2020, the total cat bond market exceeds $50 billion, up from $33 billion just 5 years earlier, a surge of roughly 50%. Issuance is climbing even faster. In the 12-month window between August 2024 and July 2025, insurers issued $23 billion worth of new cat bonds, marking the most active year in the history of the asset class. Why the acceleration? 3 forces are reshaping the insurance landscape. First, climate change is increasing both the frequency and severity of natural disasters. Insurers are overwhelmed by rising claims, and traditional reinsurance simply cannot absorb the volume. As a result, they are tapping into capital markets for extra protection. Second, rising insurance premiums mean higher coupon payments on cat bonds, making them increasingly attractive as yield-generating assets. Third, investors have learned through painful experience that cat bonds offer genuine structural diversification. In 2022, when stocks and bonds both collapsed together, cat bonds actually rose 5%. That single year changed institutional portfolios worldwide. So who is buying? A sophisticated global network of institutional giants, dedicated insurance-linked securities funds such as Fear Capital Management, Plenum Investments, and Stone Ridge Asset Management, pension funds including CalPERS and major Canadian and European pension systems, Middle Eastern sovereign wealth funds, Even multi-strategy hedge funds that historically focused on equities and credit are now allocating 5 to 10% of their assets into cat bonds. Asset managers like PIMCO, Amundi, and BlackRock offer structured exposure, and even reinsurers themselves. Swiss Re, Munich Re are simultaneously issuing and purchasing cat bonds. This is no fringe market. It is a highly engineered ecosystem. The returns reinforce its appeal. From 1997 through 2020, cat bonds generated yields that exceeded expected losses by roughly 4 percentage points annually. Investors are effectively paid a 4% premium for absorbing unfamiliar risk in a market that remains inefficient enough for specialists to spot mispricing. Those with advanced catastrophe models consistently extract excess returns. Consider a notable example. In 2011, American Family Mutual Insurance Company issued a cat bond called Mariah Re, covering tornado and severe thunderstorm losses in the United States. Investors received 6 to 1 annually, and the bond would trigger if annual tornado-related damages exceeded $80 million. Historically, such an event occurred only once every decade or more. On paper, the math looked attractive, but 2011 turned into the deadliest tornado season in modern U.S. history. 83 tornadoes, $21 billion in damages, and industry losses that reached $954 million. The bond triggered. Investors lost the entire $100 million principal. And yet, even with events like this, diversified cat bond portfolios earned an average of 11% annually between 2010 and 2020. The reason is structural. The system behaves like a probability engine. Some bonds will trigger, most won't. The high yields on the majority that survive more than compensate for the losses of the few. And because catastrophe risk is uncorrelated with equity markets, portfolios remain resilient even during financial crises. But something particularly important is unfolding in 2025. 5. The cat bond market is undergoing a major structural evolution. Historically, about 75% of all cat bonds focused on U.S. hurricane exposure. Florida, Texas, the Gulf Coast. But the landscape is diversifying rapidly. We are seeing new bonds tied to earthquake risk in Japan and California, wildfire risk in Australia and the U.S. West Coast, flood risk in Europe, and even mortality risk tied to pandemics. At the same time, issuance is shifting from reinsurers to primary insurers. In 2020, 58% of new cat bonds were issued by primary insurance companies, compared to 48% just 2 years earlier. This matters because cat bonds have become core infrastructure for the insurance industry. They are no longer niche instruments used by specialists. They are now a foundational layer of global risk management. Deeper markets mean higher liquidity, higher stability, and more predictable performance conditions that institutional investors love. In many ways, the cat bond market in 2020 resembles the mortgage-backed securities market in 2000. Early stage, misunderstood by retail investors, generating unusually high returns, backed by strong structural demand, and on the verge of becoming a mainstream asset class. Billionaires are moving in early, positioning themselves before yields decline as the broader market catches on. Now, let us connect the dots. Why do the world's wealthiest investors keep accumulating 3 very specific asset categories? Farmland, with water access, water rights, and catastrophe bonds. Because all three share the same core attributes: scarcity, essentiality, inflation resistance, and resilience to economic disaster. Scarcity. You cannot manufacture new fertile farmland above deep aquifers. You cannot create new water rights. They were assigned over a century ago. And catastrophe risk is governed by geography and climate, not by financial engineering. Essentiality, food, water, and insurance against devastation are fundamental human needs. Even in economic collapse, people still must eat, hydrate, and rebuild after disasters. These categories sit outside the luxury economy and inside the survival economy. Inflation resistance. Farmland increases in value when food prices climb. Water rights become more valuable as scarcity deepens. Cat bonds typically pay floating interest tied to broader financial benchmarks, ensuring yields rise with inflation. Disaster resilience. Farmland endured the Great Depression and the 2008 crisis. Water rights become even more valuable during environmental stress. And cat bonds are intentionally built to withstand economic crashes. They are designed around disaster risk, not market volatility. This is why billionaires are not buying these assets for modest annual returns. They are acquiring them as long-term wealth fortresses, protection mechanisms built for a 50-year horizon, assets that endure economic collapse, political instability, currency failure, and climate disruption. Assets positioned not only to survive, but to thrive when other asset classes break. They are positioning for a world where currencies are unstable, food is scarce, water is expensive, and traditional financial assets swing wildly with every shock. These are not get-rich-quick plays. They are civilization-level hedges assets designed to survive not just recessions, but systemic resets. And the obvious question becomes, how do you gain exposure to these assets without being a billionaire? You can't write a check for 6,000 acres in Louisiana. You can't outbid Bill Gates for irrigated farmland in Washington. You won't be negotiating Ogallala Aquifer water rights with Texas ranchers. And you certainly won't meet the $10 million minimum to join an institutional catastrophe bond fund. But that does not mean you are locked out. There are accessible pathways. For farmland, the simplest entry point is farmland. REITs. These are publicly traded companies that own agricultural land and pay dividends from farm leases. Farmland Partners FPI owns over 177,000 acres across more than 300 farms. It pays a quarterly dividend, and shares trade near the price of a dinner, not a down payment on a farm. Gladstone Land Corporation. Land owns over 100,000 acres of high-value produce farms and pays monthly dividends. These are not perfect substitutes for owning farms outright. No tax advantages, no direct control over water rights, but they offer exposure to rising farmland values and agricultural income streams. Instead of needing $1 million, you can start with 1,000. Another approach is fractional farmland platforms, like AcreTrader and Farm Together. These pool investor capital to buy individual farms. You select a specific property and invest 15,000 bitobas for fractional ownership. You receive a proportional share of crop revenues and long-term appreciation. Some platforms even provide soil data, hydrology analysis, and satellite imagery, so you know exactly what you are buying. It is the closest thing to direct ownership without the operational burden of running a farm. Water rights are more difficult because there is no public exchange. Rights trade privately, governed by century-old legal frameworks. But you can still gain indirect exposure. Water utilities such as American Water works own water rights and operate the infrastructure that transports and treats water across multiple states. As scarcity increases, utilities benefit from pricing power and regulatory rate adjustments. Water technology companies like Exile produce pumps, filtration systems, and large-scale water management technology. As water becomes scarcer, demand for their systems rises. There are also water-focused ETFs like Invesco's which holds a diversified basket of water infrastructure, utility, and technology firms. It is not the same as owning senior Colorado River rights, but it captures the economic upside of scarcity without navigating complex legal regimes. For catastrophe bonds, the previously closed world has opened slightly. There are mutual funds and ETFs providing indirect exposure. The Stone Ridge High Yield Reinsurance Risk Premium Fund invests in cat bonds and other insurance-linked securities, with minimums accessible through some platforms. Pioneer's Cat Bond Fund offers another pathway. These vehicles give ordinary investors access to the same risk pool pension funds used, wrapped in a liquid mutual fund structure. The trade-off is fees, often 1 to 2% annually, which reduce net returns. But in exchange, you receive professional modeling, diversification across dozens of bonds, and access to securities unavailable to individuals. Several ETFs also track the Swiss ReCat Bond Index, giving broad exposure to the entire cat bond market. You won't capture the highest alpha bonds, but you gain market-level returns with significantly lower risk and friction. Now let us be absolutely clear about what this is and what it is not. This is not financial advice. It is not a list of assets to buy tomorrow morning. It is an explanation of what the ultra-wealthy are accumulating and why. Whether you follow that playbook depends entirely on your risk tolerance, time horizon, and financial circumstances. But one thing is unmistakably happening. Billionaires are reallocating capital away from traditional assets and toward real, scarce, indispensable resources. They are not doing this to chase 20% annual returns. They are doing it because they believe the current financial architecture is fundamentally unsustainable. And when financial systems strain or fracture, the assets that matter are the same assets ancient civilizations depended on: food, water, and resilience against catastrophe. Not stocks, not bonds, not even cash. The things that feed populations, hydrate cities, and transfer catastrophic risk away from your balance sheet. Those are the assets that preserve wealth across regime changes. Bill Gates did not become the largest private farmland owner in America by accident. It was a deliberate, methodical, 12-year accumulation strategy. T. Boone Pickens did not casually end up with water rights worth $500 million. He bought them at a time when almost nobody understood their long-term strategic value. Pension funds did not shift billions into catastrophe bonds on a whim. They did it because their models revealed that traditional diversification failed in 2022 and uncorrelated assets were no longer optional. They were mandatory. The pattern is visible. The trend is unmistakable. The only real question is whether you recognize it in time to act. And the truth is, these are not the only assets billionaires are quietly accumulating. Rare earth elements, nuclear energy infrastructure, precision agriculture, strategic industrial commodities all are entering long-cycle accumulation phases. But farmland with water access, water rights themselves. And catastrophe bonds are 3 categories in peak accumulation right now, and still accessible to non-billionaires, if approached intelligently. If you take only one insight from this entire breakdown, let it be this. When billionaires begin buying vast quantities of boring, unglamorous assets that seem irrelevant to the current market narrative, pay attention. They are not buying for today. They are buying for the day when the system pivots. And on that day, the person who controls food, water, and risk transfer will be far wealthier and far more secure than the person whose wealth is tied to financial assets denominated in a currency that no longer functions. This is not doom. It is pattern recognition. Every dominant currency in history has followed the same arc, and every time, the wealthiest few who saw the shift coming moved their capital into real assets years before the transition. We are in one of those moments now. What you do with that information is entirely up to you.